Good afternoon, everyone. Assalamu alaikum. Welcome to the Cash Flow Statement Simplified webinar. My name is Adnan Aqil, and it's a pleasure to have you today to discuss this important topic about the cash flow statement. Now, just to walk you through our agenda for the day, we will be giving you an idea about the cash flow statement background, the main objectives, why this statement is there and why it's mandated by IFRS, the different sections related to the statement, and what are the approved or allowed methods to come up or to prepare the statement as per the accounting standards, and the direct versus the indirect method, what are the similarities and differences. We'll talk in more details about the rules, about the direct method, indirect, and we will be concluding by taking a practical example using illustrated financials to calculate and to come up with the cash flow statement, both on the direct side and the indirect one. Please, at any point in time, if you have any question, please feel free to ask me. Now, the webinar slides and the Excel file, I will be sharing with you at the end of the webinar through a link. And the same webinar will be published soon on our Merck website. All right, great. Now, a bit of a background on the cash flow statement. The cash flow statement was introduced by the International Accounting Standard Committee back in 1977 through International Accounting Standard number 7. Interesting, at that time, it wasn't mandatory for all companies. It was optional, actually. And when the standard was updated in 1992, and even the name has changed to Statement of Cash Flows, it became mandatory for all companies that are adopting IFRS. At that time, it was called IS, International Accounting Standard, and later on in early 2000, it was renamed as International Financial Reporting Standard as the IFRS. Now, what is the cash flow statement about? So basically, it's a statement that summarizes the changes in the cash and cash equivalents that took place within a period. So example, if we started, for example, year of 2023 by having a cash and cash equivalent of $1 million, the year ended by increasing the cash balance up to 1.5 million. So the aim of this statement is to show us during this year or this period, it could be like a month, not necessarily a year, what happened in terms of our cash elements, what were the cash received for, and the cash paid for. And the total obviously needs to equal the net change in cash and cash equivalent. Now, this important information particularly talks about the liquidity of the firm, and it helps users to assess multiple important matters when it comes to the company. In specific, the ability of the company to generate cash, which is basically liquidity. And I don't need to stress the importance of liquidity for any business. It is the real fuel that keeps the business going. Also, it helps understand and evaluate the solvency, which is like more of the long-term liquidity. It has a bit to do with the debt structure and the capital structure of the firm, in addition to the financial adaptability. Also, it helps us in comparing the liquidity and the cash position and the cash sources and uses between different companies, because this statement became more or less a standard. So all companies preparing this, and it helps us to compare, for example, the cash flow of company X with other companies, mainly competitors, companies in the main domain or the main sector as such. And importantly enough, if we are basically shareholders, we are partners in a firm, we will be much concerned about the firm ability for the distribution of profit. This is what we call dividends. So that is a great indicator whether the company is paying dividends or it has enough cash to generate and to basically distribute such dividends. Equally important for the lenders of the company, for example, banks, financial institutions, they would like to assess the company ability to repay these loans and settle these liabilities, whether, for example, we are vendors, suppliers. So, and also uh, how the company's ability to fund the growth of the business. Now, in like general circumstances, companies they have to keep investing in their fixed assets and their projects and growing their markets. So this is an important element that also can be sensed from the cash flow statement itself. Now, as per the accounting rules, the cash flow statement has three main sections. It starts with the operating activities. Now, operating activities, these are should be more or less the main contributors or the main generators of the cash within the entity. So as we all expect, like the income, the company itself needs to generate profit from an income statement side that represent the revenues less the cost. Similarly, the cash flow for the firm mainly should come from the main or the core activities of the business that falls under the operating activities. In a nutshell, the operating activity cash flow is related to the, for example, sales of goods or services provided, in addition to the dealings with like suppliers and the operating expenses, the cost of employment. All of this would fall under the operating activities. The next category is the investing activities. The investing activities has two main elements. When we say investing, the first thing comes to our mind is okay, pure investments like buying shares, buying maybe bonds or sukuk, selling those financial instruments. All of this buying and selling these financial instruments falls under investing by default. But in addition to this, it includes the acquisition and the sale of fixed assets, that is called property, plant, and equipment, intangible assets, and other long-term assets in the, for example, investment properties. Now, why buying a fixed asset is considered more of an investment? Because of multiple criterias. Number one, the value of such assets are considerably material. The other thing that normally these assets would live, for example, for long period, and it would serve the entity for a long period. Hence, when a company, in a manufacturing company, for instance, is investing or buying machineries and they are buying equipments for the factory as such, that is more of an investment rather than an operating cash flow. The last section of the cash flow statement is related to financing activities. And financing activities, in reality, it talks about the dealings with the sources of funding for the business, which are the equity side, dealing with the shareholders, receiving money from the shareholders when we are selling them shares and increasing our capital size, or vice versa, when we are paying to the shareholders dividends, that would fall similarly under investing activities. On the other side, when we deal with lenders, banks, financial institutions, receiving new loans from them, that is by default an financing activity. And similarly, when we repay these loans or bonds, for instance, that also falls under financing activities. Now, most users, they know for sure that the cash flow statement has three sections only. That's right, but the accounting standards is also mandating the firms, whomever having material, non-cash investing and financing activities, which I will explain briefly now. If any such activities they occur or they take place, such activities they have to be disclosed separately in the notes of the financial statements. It could be within the cash flow statement, but at the bottom. It is not part of the cash flow statement calculation, or separately in the notes or in the disclosures. Now, what are examples of non-cash investing and financing activities? For instance, lots of companies, they issue bonds. And some of these bonds, to give flexibility for the issuing company, they are called convertible bonds. Convertible in a sense, if the firm believes that they no longer needs these bonds, or these bonds are becoming really expensive in terms of the interest that they are paying on it, they have the option or the choice to convert these bonds into common shares, meaning the bondholders, they no longer hold the bonds. Instead, we will close these bonds, and instead we will give them shares. So instead of the bondholders are part of our liabilities, they become part of our equity, part of our capital and shareholders. This is one example. The other example, for instance, if we acquire a company, or if we acquire a major asset in the business by issuing shares, that is an equity, or by issuing bonds or sukuk, for instance, that is like a debt instrument. And also sometimes we would, for example, we have a liability, or we have, for example, a loan for a bank, and we have no liquidity. So we reach a settlement with this lender or this supplier that we are going to settle this liability by giving them an asset as such. So all of these are examples of non-cash investing and financing activities. If they happen in the firm, they are material enough, they have to be disclosed in the notes of the financial statements. Now, back to the IAS 7. IAS 7, when it talks about the preparation of cash flow statement, it is clearly giving us the option whether to follow the direct method or the indirect method. Now, in either case, whether we are following direct or indirect, we have to prepare the three segments, or the three sections, the operating, investing, and financing activities. But the only difference when it comes to direct versus indirect is in the first section, which is the operating activities. And once we go into the details and we go into the practical example, that will be very much clear. Here I have a high-level comparison between direct and indirect. If we follow the direct method, the aim here is to present very clearly from an operating perspective the cash received and paid. As we understand, the main source of cash from an operating perspective is the cash received from customers, obviously, from selling our products or providing our main services. So cash received from customers needs to be clearly presented. On the other hand, cash paid to suppliers, that needs to be presented. This is obviously for the purchase of raw material or the purchase of services required for us in our core operations. And the third important element is our HR element. All the cash paid to our employees, whether it is for salaries, for allowances, whatever is the case, that also needs to be disclosed separately. Here, in specific, I'm talking about the direct method. Now, the direct method, mainly, it is, first of all, it is the approach or the method recommended by IFRS. However, the reality is different. In reality, companies, they prefer the indirect. And why it is recommended? Because basically it is more transparent, and it is laying out the cash flow in a very clear manner and easy to understand and analyze. On the other hand, the indirect method, why it's called indirect? Because it starts from where the income statement is ending. The end of the income statement is the net profit or net loss for this particular period, could be a month or could be a year. Now, this net profit or net loss, it is calculated based on accrual basis, not on the cash basis. Meaning, if a company achieved $1 million of profit for year 2023, doesn't mean that the cash increased by the same amount, which is 1 million. Simply because some revenues, they were recorded, but still not yet collected. They are still lying in receivables. And similarly, some expenses are recorded, but still they are not paid. They are still lying in liabilities as accruals or accounts payable. So the aim of the indirect method is take the net profit for the year and convert it from an accounting profit to a cash profit. So the aim is to convert the accounting profit that comes from the income statement or the P&L from an accounting profit into a cash profit. How this conversion is done? Mainly by 3 steps. Number one, you have to look at any non-cash expenses in the likes of depreciation, amortization, provisions, for example, provision for bad debt, provision for slow-moving inventory, any such provisions or non-cash expenses, they have already been reduced from the net profit. However, they were not paid. So these are called non-cash expenses. So they have to be adjusted, meaning added back to the profit. In addition, we need to also treat the working capital components. In specific, the components of the current assets and the current liabilities. Mainly, we have the account receivable, inventory on the current asset side, and the accounts payable on the liability side. So they have specific rules how to be treated. I will share them with you. And the last one is if we have any gain or loss resulting from the sale of long-term assets, also that needs to be treated, and we will have an example on this one. So the key features of the indirect method, it is easier to prepare, but not easier to understand and interpret and use as well. However, it is widely used, and this is the most common method used by companies, simply because it is easier to prepare and it is allowed by IFRS. This is an example to compare the direct with the indirect. On the left-hand side, we have the direct. So this is in specific in relation to the operating activities, because this is the only difference between the two methods. As you realize, we start by how much did we collect from our customers? And obviously, this is coming from our sales. How much did we pay to our suppliers? How much did we pay to our employees? If there are any other payments, for example, for interest or receipts from interest as well, whether interest income, interest expense, that needs to be disclosed here as well. Since it's a cash flow statement, it's imperative that we need to distinguish between the cash received and the cash paid. That is the cash inflow and the cash outflow. The cash inflow is a positive figure, like the 108 million coming from the collection of customers, while any paid amounts or cash outflow in the likes of the amount paid to suppliers, that needs to be a negative figure, and normally we use the 2 brackets to designate the negative figures. Now, on the right-hand side, we look at the indirect method coming from the in relation to the operating activities. As we said, it mainly starts with the net income. So we get the net income as it is shown on the P&L, and then this needs to be converted into cash profit rather than an accounting profit. So for instance, depreciation expense, that and any non-cash expenses, they have to be added back because already deducted and not yet paid, hence they have to be added back. And then we are going to treat the changes in working capital, mainly account receivable, inventory, and accounts payable, in order to get into the total cash from operating activities. Now, as you realize, whether we are following the direct or indirect method, the total cash from operating activities must be equal, must be the same. So result is the same, but the only difference is the approach, how we get into these numbers. And as a general rule, whether we are doing it the direct or the indirect method, in order to prepare a cash flow statement, we need a balance sheet for 2 years, for the existing year and the year before, in addition to the latest year for the income statement. Without having balance sheet and income statement, it's next to impossible to prepare a cash flow statement. Okay, now under the direct method, we know that, okay, we need to calculate the cash receipts from customers. In order to get into this number, we have to do some analysis between the accounts that are influencing the cash received from customers, mainly the sales account and the account receivable. When we talk about amounts paid to suppliers, then how do we figure it out? We have to analyze the inventory accounts, the cost of goods sold, plus the accounts payable. And to figure out how much did we pay to our employees and headcounts, we have to analyze the expenses and the payable if there are any accruals or any liability towards the employees. This will be part of our practical example, and we will see how these are analyzed and calculated. Now, for the indirect method rule, as I explained, the aim is to convert the accrual profit or the accounting profit into a cash profit. So this is the main aim here. And how? By doing certain adjustments. These adjustments are summarized here. As you see at the top, we start with the net income. Then we need to adjust for the non-cash expenses. So in particular, any depreciation or amortization expenses are added back. Any additions to provisions and impairment means any new provisions or impairment done, that also needs to be reversed by adding it back. Sometimes we do the opposite. We have already assumed certain provisions or impairments in previous periods, and in this year or this period, we come to a conclusion that now there is no need. Based on the business circumstances, no need. Hence, they will be written back or reversed. That will have the negative impact here. We have to take them out. If we have any gain on sale of long-term assets, that will be removed. If we have a loss, that will be added back. By doing these adjustments, we have reached our net income adjusted for the non-cash items. The last step is to adjust for the working capital. The rules here are quite simple. If current assets, regardless whatever is there, account receivable, inventory, prepaid expenses, those current assets, they have decreased, this is to be added back to cash. Vice versa, if they increase, that is a reduction in cash. And on the other side of the balance sheet, on the current liabilities, increase in current liability is an increase in cash, and decrease in current liability is a reduction in cash. Once we apply all these adjustments, we get into our final number, that is the net cash flow from our operating activities. Now, let's go into our practical example to apply these basically ideas or methodology. What I'm going to do here is the following. Now, as we said, I need basically a balance sheet with 2 years, as you see here. I believe you can see my Excel screen, right? So,
Yes.
thank you. So this is the latest for 2023 and comparative figures for the previous year, 22. On the balance sheet side, that includes all my assets, liabilities, and the equity. And of course, it needs to be balanced. So total asset must equal total liability and equity for each of these years. On the other side, I have my income statement. This is only required for the last year, which is 2023. I have sales, less cost of goods sold. My gross profit is there, less my operating expenses, salaries, depreciation, rent. That takes me into my operating profit. I take out my interest paid on the bonds. I add the gain on sale of land, for instance. I add interest income from, for example, my fixed deposits, and that will give me my net income. Now, what is the aim? On the right-hand side, I have the cash flow statement on the direct method, cash flow statement on the indirect method. And as we explained, both of them, they should have the three sections, the operating sections to start with, then the investing section, and to be concluded by the financing section. So this applies to both of them. Now, in order to prepare cash flow statement in a proper manner, as we said, we need to do some accounts analysis to figure out where is the cash coming from, where is the cash being used or invested for. So I'm going to do this here. This is the financial sheet, and I have an accounts analysis sheet. To start with, we are going to fill these analysis. Now, my first aim is to calculate how much did we collect from our clients and customers. So as we said, this is dependent on the sales as well as the account receivable. So I need to start with my account receivable. How much was my account receivable beginning of the year? So here, simply that equals my beginning receivable balance, that is 30 million. I need to add my sales during the current year, 2023. So this is linked with the sales in the P&L, 110 million. Now, logically speaking, if I started my year by 30 million, added credit sales, mostly sales are credit 110, so that will give me an AR balance of 140. Now, how much I am left with end of the year? This is my ending balance. That is 32. So in total, I accumulated 140 of receivable. However, I ended the year by 32 only. So where did the difference go to? Obviously, the difference is related to the collection made from customers during the year. This is simply calculated as the ending balance minus less the beginning, less the sales for the year. So now I know that during this year, I have collected 108 million from my customers. Okay, next, I would like to move into calculating how much did I pay to my suppliers. In order to get into this number, I need to understand what would influence my payments to suppliers. Mainly, it is influenced by the purchases, and the purchases is influenced by the inventory account and the cost of goods sold as well. So I start by calculating, first of all, how much did I purchase? Starting with my inventory, beginning balance, that is, I started with 50 million of inventory. Now, how much did I purchase? Still, I don't know. I will come to this later. Okay. How much did I sell goods for? That is cost of goods sold, for instance. This is coming from the cost of goods sold, 60 million. And how much I ended the year with as ending inventory from the balance sheet inventory value, 40. So what is the simple logic here? After selling 60 million here, I am left with 40 million. So in this case, so again, after selling 60 million worth of goods, I am left in my warehouse with 40 million. So it means I used to have 100 million. I used to have 100 million worth of goods. After selling 60 million, I am left with 40. So this is the first fact. Now, this 100 million of available goods for sale, how much did I have out of this beginning of the year? It was 50 only. So I started with 50. I ended up having 100. So how much did I buy? Basically the difference. So goods purchased equals the ending balance less cost of goods sold less the beginning balance that is 50. So in another way, I started the year with 50 million. I added or I purchased another 50 that took my figure in total 200. Now the 100 is what I call the goods available for sale. Out of the 100, I sold 60, hence my ending balance was 40. These steps are only to calculate the goods purchased. Now I will take this figure to calculate how much did I pay to my vendors on the premise that these goods were purchased from credit or from my vendors on account. My accounts payable beginning balance, this is from the balance sheet itself, it was 59 million. Logically speaking, I need to add to this number the goods purchased during the year on credit. Now, how much was the ending liability or ending accounts payable for my supplier? It went down to 33. So I started the year with 59, bought goods worth of 50. So the total becomes 109. 109 at the end of the year went down to 33. Why? The difference represents the actual amounts paid to suppliers during the year. So this is simply calculated as ending balance less beginning less the goods purchased during the year. So now I know for a fact that I have paid my suppliers during this year 76 million. Similarly, I would like to understand how much did I pay to my employees. This is more or less the same. What was my liability to the employees beginning of the year? Salaries payable was 7 million. I will add to this the salaries expenses. So here, salary expense is 20 million. The ending balance for the liability towards employees went down to 3. And how much actually I paid them is the ending balance less the opening balance less the salaries or expenses for the year. So I paid them 24 million. What is the logic here? I started with the year with 7 million liability towards my employees. During the year, they provided me with services. I recorded salary expense of 20. Now, if these salaries were not paid, my total liability towards employees would have been 27. Since it went from 27 to 3, meaning the difference is the actual cash paid to the employees. Now, on the other side, I would like now to calculate what happened to my land. If I come to the balance sheet, I realize that land started with 80 million and ended with 60 million, meaning during the year, I have sold a land that has a cost of 20. At the same time, I can see in the income statement, there is a gain or a profit from selling this land for 8 million. So the question, how much did I receive from selling the land? Okay, how is this calculated? I start here. What was the beginning balance of the lands? From the balance sheet, this is the 80 million. Now, next, what was the gain from the selling of the land? This is the 8 million from the income statement. What is the no, actually, let me do the following. Okay, first, what is the ending balance for the lands? So 60. So simply, I started the year with 80 million worth of lands. The year ended with 60, meaning there was a land that has a cost of 20 million that I sold. So this equal the ending balance less the opening balance, just to let me know that the land or the maybe like multiple lands that I sold, they had a cost of 20. Now, when I'm selling these lands with a cost of 20, I have achieved a profit of 8. So this cost, I'll just edit it here. All right, so now the simple logic, When I'm selling a land that has a cost of 20, I have achieved a gain or a profit of 8. So how much did I sell it for? Simply, it is the sum of the profit plus the cost of the asset sold, that is 28. This is the logic how we calculate proceeds from sale of land, means the cash received from selling these lands. When it comes to the equipment, the challenge is normally these fixed assets, they already been depreciated during the year, and lots of times we buy new assets. So here I would like to know how much actual cash did I pay to purchase a new fixed assets or equipments as such. Here I need to analyze the fixed asset account plus the depreciation account. I start with the equipment beginning balance. So the year started with 55 million of equipment. Now, how much was the depreciation for the year? This is coming from income statement. Depreciation expense was 5 million. Okay. Now, what was the ending balance for the equipment? This is from balance sheet 75. So what is the logic here? I started the year with 55 million worth of assets. During the year, they were depreciated by 5. So from a net book value perspective, assume I did not add any single asset. What should be my ending balance? The opening balance, 55 less the depreciation of 5. So it should be 50. But in reality, how much is my real ending balance? 75. So the extra 25 million is the amount of cash used to purchase equipments during the year. How is this calculated? It is the ending balance less opening balance minus the depreciation. So I have paid 25 million for the purchase of new equipment. Last item on my analysis sheet is I need to figure out, did we pay dividends to shareholders? If there were any dividends paid, how much are these dividends? When I talk dividends, it's all about retained earnings and profit for the year. So what was the opening balance for the retained earnings? From the balance sheet, I started the year with 25 million. What will be added is the profit for the year. That equals the net profit for the year, which is the 34 million. So now what is my ending balance for retained earnings? From the balance sheet, ending balance coming to 45. Now, what is the logic here? If I add my opening balance plus my profit, my ending balance should be 59. Assume I did not pay any dividends, but in reality, it is not 59, it is 45. Hence, the difference represented by 14, this is the actual dividends paid for the shareholders during the period. This is calculated by taking ending balance less opening less the profit for the year. And now I know that during this year, we have paid 14 million worth of dividends. So this is the first step to do such analysis for the accounts in order to figure out specific items required to fill or to prepare the cash flow statement. Now we are ready to prepare the cash flow. I'm going to start by the direct method. So collection from customers, this is already calculated and the figure is here, 108. But since it's collection, it needs to be positive rather than negative. Payments to suppliers, similarly, this is the figure. Payments to suppliers, the 76 million. Payments to employees, it's already calculated, and here we go, 24 million. The income statement is telling me that there were bonds interest expense. So on the bonds that we are holding, we have paid interest of 5. As long as I don't see here any unpaid interest, it is basically assumed that fully are paid. So bonds interest paid equal the bond interest expense from the P&L itself. Similarly, interest income of 9, that is assumed to be fully received because I don't have here any interest income receivable. So the interest income received is the actual interest income disclosed in the income statement. Next, I'm going to let me fill the investing activities first. So here, my purchase of short-term investment. So under the short-term investment, I realized I started the year with zero balance, and during the year, the ending balance was 12 million. So logically speaking, I have invested 12 million. This equals minus 12. That is the delta or the difference, minus because it's an investment or cash paid out. Proceeds from the sale of the land. How much did I get by selling the land? That was calculated in the analysis sheet. The land proceeds, that is the 28 million. Purchase of equipments. How much did I invest in equipments? Also calculated here. That is purchase of equipment 25, but logically it needs to be negative because it is paid. So my investing activities has 3 components. The short-term investment acquired, the sale of the land, cash received, and the purchase of equipment. The total is the 9 million negative. Hence, my investing activities overall consumed 9 million of cash. Now I move into my financing activities. Financing, I said it's all about my dealings with the shareholders and the lenders. So here I'm mainly concerned about this section. Let me start with the bonds. I used to have bonds worth of 50. It went down to 40. Logically speaking, I have repaid bonds worth of 10. So retirement of bonds payable, this equals the reduction in bonds worth of 10 million. Now, if I look at my capital, I started the year with 100 million, ended the year with 130. Logically, I have increased my capital, issued new shares, and basically sold these shares and received the cash. So sale of common shares equal the amount of the share capital increase. And the payment of dividends, this is the amount calculated in the account analysis. Here, the dividends paid, we agreed on the 14 million figure. Now, my financing activities overall, it generated 6 million in total. All right. Now, how is the story concluded? My operating activities generated 12 million. My investing activities utilized 9 million, and my financing activities generated 6 million. What is the total of the 3? It is basically the 9 million here. So this is the total of the 3, and here it is called the net increase in cash during the period. If it was a negative figure, that would have been called the net decrease in cash. How do I know if this is accurate? Because at the end, whatever cash I'm displaying here, it needs to be matching with the balance sheet. The cash is part of the assets. So what is my balance of cash beginning of the year? Equal, here it is, the 20 million. So I started the year with 20 million, and the cash flow is telling me your cash has increased by 9. So logically speaking, my ending balance cash needs to be 29. Is this matching with the balance sheet? Yes, it is matching. If this figure wasn't matching, there is something wrong and the cash flow is not accurate. So cash flow is telling me your overall cash increased by 9. How is this correct? Yes, because I started with 20, adding the 9, it takes me to 29. And yes, I started in 20, I ended by 29. That is absolutely perfect. On the other hand side, let's see how the indirect cash flow is calculated. Now, I start with my net income. So equal net income that is resulting from the income statement, 34 million net income generated. I need to do adjustment. Depreciation expense was taken out from net income, but it is non-cash. So this needs to be added back. Add back the depreciation of 5 million. It needs to come positive here. Now, for the investing and financing activities, since it is the same, allow me just to replicate it here. Okay. Now, when it comes to the gain on sale of the land, I know for a fact that yes, I have sold a land and I have received a 20 million out of selling this land. However, in the income statement, I have recorded the profit or the gain on the sale of the land, which is the 8. And this 8 is part of the overall profit, the 34. So since I started my calculation here from the net profit, the gain or the profit from the sale of the land, it is somehow duplicated. It is accounted more than one time, actually twice. Why? It is already part of my profit for the year, and it is already part of my cash from selling the land. So it cannot be duplicated. How do I fix this matter? I come here as gain on sale of land, and then I take it out. This needs to be reduced. The last thing, how to calculate or to deal with the changes in receivable, payable, inventory, the components of current asset and current liability. Again, just a reminder, here I am applying the rules that we have just explained here. These are the rules. So now account receivable increased. This needs to be taken out. This is a deduction. So this negative, the change, the 2. Inventory decreased. This is positive cash. So this is inventory, the 10, that is positive. Here I'm talking about the delta, which is the difference during the year. Prepaid rent decreased. This is positive cash. Prepaid rent reduced by 3. This is as if receiving cash. On the other side, on the liability, both AP, accounts payable, and salaries payable, they declined. In both cases, when a liability is decreasing, that is a positive cash. Sorry, this is negative cash, as if I am paying back to the suppliers. So this, the reduction in AP, this takes out 26 million of my cash, and the reduction on salaries payable, this takes out 4 million of my cash. Now, the most important thing, the net cash flow from operating activities, as you see it here, should be equal in both cases, whether under the direct method or the indirect method. If it is not equal, if it is not the same figure, there is something wrong, and you must reassess your work to figure out what is the matter that is creating this imbalance, and it needs to be corrected. And similarly, we come here and we see that the remaining portions, whether investing act or financing, also they are the same. So with this, I conclude my webinar. I hope you found this webinar useful. Please, if you have any question, you are more than welcome. Please go ahead and ask me. Just a reminder, this webinar is recorded. It is going to be published on our website. We have a specific page for webinars. And also, before I end this webinar, let me share with you the Google Drive link where you will be able to download the Excel file and the slides that I have used here. In the meantime, please, if you have any question, please go ahead and ask me. All right. Now, the link to the webinar files are already now shared with you in the Zoom chat. Did you receive it? It should appear in your chat box. Okay, great. Thank you, Muhammad. All right. Thank you, everyone, for your attendance today. I hope you liked the webinar on the cash flow statement. Again, I try to simplify it as much as possible. I think if you are tasked with preparing cash flow statement, you have to practice. You have to do more practical, practice on this, and yeah, just remember the rules. Direct method, indirect method, you have to go back to the accounts analysis. Once you do your full analysis, you are ready to complete the cash flow. All right. Thank you, everyone, again, and hope to see you in future webinars.
Thank you very much, inshallah.
Thank you.
Thank you.
Thank you very much. Thank you. But mute, huh? Mute.
Merck.com